Merry Christmas to everybody. Of course, 2-to-1 advancing to declining stocks. And that's the big story, guys. Every day, the breadth of the market advances, broadening out. And that's one of the reasons we're new highs here. Hope you like that fire. I feel like I need a glass of cognac and a Perry Como sweater at this point. The sectors are cyclicals that keep moving here this month. Energy stocks, metals and mining. Real estate's been a little bit weak. Some of those retail mall REITs have had some issues. Of course, we understand what that is. And oil and gas and exploration companies, they're having a little bit of a moment here moving up. Remember, you get this mean reversion. The old losers tend to be bigger winners in the new year. December of last year, we talked a little bit about this yesterday, what a cascading series of events it was up until this moment. Last year, remember, President Trump tweeted he was tariff man on December 4th. We had a drop notably on the S&P, 3% that day. December 19th, the Fed hiked, and that created a cascading series of 4 just lousy days in the market, culminating today, December 24th, down 2.7%. Also, remember, we had Steve Mnuchin making some confusing comments. He had talked to the heads of some of the big banks. They had ample liquidity. Nobody knew what he was talking about. Other people came on and said, no, it was really about discussions about Powell and the Federal Reserve and the economy and how things were doing. And everybody was thoroughly confused by the end of the day on December 24th. At least we had a bottom of some sorts at that point. Remember what was going on. Of course, if you take a look at the markets here, by that time, December 24th, we were down 15%. So if you take a look at the S&P, there we go, the tariff man, the Fed hikes, and we bottomed and bounced back in the last couple of days. The good news is all that's over. We don't need to worry about it because everything is exactly the opposite of what it was on December 24th of last year. Trade and tariff war, it was heating up last year. Now there's hopes for truth. The Fed was raising rates last year. Now they're neutral and have been cutting rates at the end of this year. The global slowdown, well, we were worried that it was cascading down. We were going to have a very big earnings recession. Didn't happen. There's talk of a bottoming now, and there's certainly no talk of a recession, at least in the first part of 2020. And remember, we also had a U.S. government shutdown that was looming. That was a big issue. That's kind of faded in everybody's memory, but that's not happening. Of course, we have no shutdown. Is the market going to be up or down in the next year? I get this question every time this year, and the answer is nobody knows, but play the averages. I tend to look at what happens to the S&P year over year with the dividend. That's total return, including the dividend, which is 2%. Right now, guys, in the last 90 years, the S&P 500 year over year has been up 72% of the time. When you include the dividend, it's been down 28% of the time. Next Thursday, this coming Thursday, we'll talk a little bit about the long-term averages and how the stock market works under very long cycles. But the bottom line is, stick with the markets. They generally tend to be up year over year. Guys.